Australian farming is a risky business. The combination of diverse climate, fluctuating commodity prices and limited subsidies means our gross income is more volatile than other sectors of the Australian economy and other farmers around the world. Put simply, Australian farmers play the riskiest game in town. Understanding and managing risk is fundamental to running a profitable and sustainable farming business. Hi, I'm Cam Nicholson and welcome to this series on production risk and decision making. I reckon when you hear the word risk, the first thing that pops into your head is what could go wrong, the downside. However, risk is derived from the Italian word called risicare, which actually means to dare. So while there's a downside, there's also an opportunity or upside. Managing risk requires making choices or decisions about how much downside you're willing to accept to try and capture the upside. And to make good choices, we need to form an opinion about the odds or the chances of certain results occurring. No one has a crystal ball to predict the future. However, history can be useful at times to understand past results and how often they've occurred. I call history our form guide, and the results can be useful in understanding the extremes and how volatile yields and prices are. To do this, we need to understand some key concepts. We're going to take a look at three factors which influence our understanding of risk. The first is the shortcoming of averages in portraying risk. Secondly, we'll have a chat with James Manson from Southern Farming Systems about different ways of presenting data so that we can be more clear on the picture of risk. And thirdly, we'll talk about correlations of different commodities and how they influence the effectiveness of diversification. These concepts are important in us being able to understand history as a form guide for our decisions. When we have a better idea of the odds of a decision, we're more able to make a good decision that fits our situation. So let's get stuck in. Averages are used a lot in agriculture. We talk about average rainfall, average yield, average prices and average stocking rate. But if we got the average every year, there wouldn't be much risk because we could predict with confidence what outcome we'd get. Risk lies in the extremes and the volatility around the average. Averages tell us nothing about risk. Consider the annual production of wheat and wool grown in the Wimmera in Victoria between 1990 and 2019. According to the ABS, the average wheat yield is 2.3 tonne per hectare. The number of years we actually got 2.3 tonne per hectare, plus or minus about 10%, so 2.1 tonne per hectare to 2.5 tonne per hectare, is only 2 out of 30. For 28 of the 30 years, we got everything but the average. Contrast this with wool growing in the same region over the same time period. The average wool cut was 4.3 kilos per head clean. The number of years we actually got 4.3 kilos per head, plus or minus about 10%, is 23 years out of 30. Annual wool cut was much closer to the average, so could be considered far more predictable, less volatile or less risky. Different commodities at different regions will have different risk profiles. The same occurs with prices, with some commodities having a greater volatility than others. But how do we summarise that information so that from a glance we can better understand the volatility and risk from historic data? We're going to hear from James Manson, a Senior Research and Extension Officer at Southern Farming Systems, about ways we can look at data to help us construct our form guide and better understand the odds around our decisions.
Thanks, Cam. Our problem these days is not so much a lack of information, but more its overabundance. With just a few clicks, you can find full data sets of yield and prices and market trends, and in the face of that amount of information and that level of complexity, it's tempting to just take an average and call it a day, isn't it? It's natural, in the face of that kind of complexity, to want to simplify, but as we saw with averages, it's possible to oversimplify. And the challenge is how do we do justice to how complex things really are, but still present things in a way that's simple and easy to use. I want to show you three ways that you could present data that'll help you navigate complexity, but still make it easy for you to make better decisions. They are quantiles, histograms, and box and whisker graphs. You can break your data down into quantiles, which is just a fancy term for groups of data. What you do is you rank your information from smallest to largest, and then you break it down into equal-sized groups. And there can be as many groupings as you like. There are quartiles, which is 4 groups of data, terciles, which is 3 groups of data, or you might have heard people talk about rainfall as being decile 1 or decile 8. A decile is just a kind of quantile that divides the data into 10 equal-sized groups. Here we've taken 30 years of growing season rainfall, ranked them from lowest to highest, and then split them up into 10 groups. It's a lot simpler to just say we had a decile 2 or 3 year, and in doing it that way, we also put it in context of the variation of our seasons. We're saying that if it was a decile 2 or 3 year, then it really was pretty dry, and that's why things are struggling. Or again, if someone says it's forecast to be a decile 8 spring, it gives you the heads up to pull the spreader out of the shed early and order extra fertilizer, because it's shaping up to be around 80% of the wettest spring you ever had. This helps us make a decision by simplifying rainfall information in a way that appreciates seasonal variability. It's common to work in deciles, but you can really break down the information into as many groups as you like. For example, Agriculture Victoria's forecast for profit breaks down seasonal variation into thirds, where blue is the wettest third of all years, yellow is the middle third of all years, and red is the driest third of all years. This enables them to look at the change in frequencies of wet, average, and dry years when there's a La Nina or El Nino event. When we look at the data like this, we can see that the newspapers can sensationalize La Nina and El Nino events somewhat. We can see that if it's a La Nina year, that the chance of being in that wettest third of years only increases from 33.3% to 36.7%. So it's really only a small change in that kind of year. By contrast, an El Nino event is much more influential. If it's that kind of year, we jump all the way up to a 63% chance of being in that driest third of years. So the chance of being dry in an El Nino is much greater than being wet in a La Nina year. But still, we're looking at a 37% chance of being in average or wet conditions even in an El Nino year. So it's not as simple as 1 equals wet and 1 equals dry. And by looking at the data in this way, we've protected ourselves from oversimplifying the situation so that we can make better decisions in a complex range of scenarios. Another insight we can get from historic data is to look at how frequently certain values have occurred in the past. We can illustrate this in different ways, but one that I like is to count up the number of times that a certain thing has occurred and present it in a frequency graph or a histogram. Histograms take all the data, set some appropriate ranges, and then count up the number of times that those values fit in those ranges. By stacking them up like Lego blocks, we get a visual image of what are the most frequent values we can expect. In this example, the historic weekly price adjusted for inflation for 19 micron wool is presented. The average price is 15.56 cents per kilo clean. Taking this information and graphing how often or frequently different prices have occurred over time indicates the most frequent price, the tallest bar, is between 12.64 cents and 13.62 cents, well below the average of 15.56. The graph is skewed, with the average being dragged up because of the very high prices that happen only infrequently. The shape of this histogram is created by supply and demand. You can store wool, and so if the price becomes very low, you're not as likely to sell until the price improves for you. And in fact, when lots of people are holding on to their wool to sell at a better price, it actually drives the price up a bit. That means that we don't have as many values at the lower end of the spectrum. On the other hand, at the upper end of the spectrum, you can imagine two people fighting it out for a limited amount of wool, and their competition between each other drives some of those higher prices up even higher. That means that we don't have as many values at the lower end, we've got a lot in the middle, and a long tail at the upper end. Wouldn't it be nice if we could bring all of that information together? Quantiles, averages, and histograms. I've got good news for you, we can, and it's called a box and whisker graph. Box and whisker graphs look like this. They break an ordered data set down into 4 quantiles, which we call quartiles. And the first quartile is the lowest quarter of the values. The second quartile is the second lower quarter of the values, and so forth. So the first 2 quartiles show the lower half of the values, and the middle line shows the median. And the third and fourth quartiles show the top half of the values. And that black dot, that's the average. A few things jump out from this chart. The first is that the lower values are squashed together, whereas the upper part of the chart is stretched out. That shows that there's a lot of information, a lot of data points in those lower ends, and only a few extreme values in the upper reaches, creating a skew, which means, like we saw before, that the median is less than the average. So when we're making a budget, we could use an average, but we can see from the box plot that that is going to skew our predictions. It might be more meaningful to use a median, but it's also best to have this box plot in mind so that we can think about the variation that's going to affect our bottom line. So remember, the way we look at data is really important for creating a form guide that informs our decisions so that we can make better decisions in a complex world.
Thanks, James. We've covered a lot of ground so far, and there's still one more to go. But first, let's have a quick recap. We've learnt that risk has both an upside and a downside. So it's not just about things that can go wrong, but also when to take an opportunity. To know how likely a decision is to pay off, we want to have a kind of form guide to frame the odds. We've seen that averages really don't tell us anything about risk. Instead, we're better off looking at the data by either breaking it down into quantiles or plotting it into a frequency histogram to see if there are any skews in the distribution. Or really helpful, we can combine all that information into a box and whisker graph so we can see the skews, averages and quantiles to help us frame the odds around our decision. Finally, we're going to take a look at correlations. We've all heard the expression, don't put all your eggs in one basket. It's another way of saying we need to diversify to manage risk. Diversification in farming is not new, and it can be a useful way of managing risk, but only if the different commodities chosen don't follow the same yield and price patterns as other commodities produced. These related patterns are referred to as correlations and indicate if two commodities follow each other across time or if they're independent. The strength of a correlation or co-relationship can be calculated mathematically in what's called an R value. It has a scale of -1 to +1. If there is no connection or co-relationship between the two items, it is considered a zero correlation. If one commodity exactly follows the size and direction of the fluctuation of the other commodity over time, it is positively correlated and given a value of +1. Conversely, if one commodity exactly follows the size and direction of the fluctuation of the other commodity over time, but in the opposite direction, it is negatively correlated and given a value of -1. A couple of examples may help. If we compare the wheat yields in the Wimmera that we saw before, say to canola, we see that good wheat yields correspond with good canola yields. The R value is 0.89, close to 1. This makes sense, two winter crops that are likely to experience the same seasonal conditions. But if we compare the same average wheat yields to the wool cut that we saw before, the correlation is much weaker. We could have good wool cut in a poor or good cropping year. The R value is much closer to 0 at 0.17. The same could be done comparing prices. Not surprisingly, there's a very weak correlation between wool prices and wheat prices, but a much stronger correlation between wheat and canola. Knowing a weak R values is just as useful as knowing a strong R value. A weak R means you haven't put all your eggs in the one basket. Risk is personal. Your values, beliefs, goals, past circumstances and experience will all influence the way you view risk. The concepts presented in this video help you understand risk and how to analyse it. But just remember, the right level of risk is that allows you to sleep comfortably at night.